Hello, my name is Perry Tepperson. I'm a CFA charter holder and also an actuary by profession. I work in the investment consulting industry, advising a wide range of clients regarding investment strategy issues. And today we're going to be talking about portfolio management, with particularly application to setting investment policy for institutional investors. Now, when setting an investment policy for an institutional investor, there's a number of key points you want to bear in mind. Firstly, these investors have liabilities or obligations. The most important aspect of the program is going to be covering those obligations. So you, as the writer of the exam analysis of the situation, you've got to show an understanding of the situation, demonstrate that you understand the nature of the entity you're dealing with, the type of the liability, be sensitive to the concept of matching assets and liabilities, and focus on these two items that you've covered elsewhere in the program: R&R, risk and return, and the constraints of LTLTU, liquidity, tax, legal issues, time horizon, and unique factors. Now, starting off in pension plan land, these are some of the major investors in our economy. There really are two major types of pension plans: defined benefit, or DB, and defined contribution, or DC. Defined contribution plans, often referred to as perhaps 401k plans in the US. In terms of the differences between these two, let's look at our slide. First of all, there's a different promise. In the case of the defined benefit plan, the benefit is promised. There's a certain formula that employees receive given their career with a company, and it might be perhaps a 2% of final pay per year of service time type of formula. So if they've been there for 10 years, they might get 20% of final pay. The promise for a DC plan is very different. The contribution is promised. The benefit is not promised. The employer might match or just simply contribute a certain amount into an account for the employee, and ultimately the employer will use the account value to purchase some benefit at retirement. In the case of a DB plan, the contribution is actually unknown because the benefit has been promised and the contribution needs to be necessary to pay for those benefits. So an actuary will need to advise the employer how much to contribute to keep that pension plan in a financially healthy situation. The employer's liability then is quite different. In the case of a defined benefit plan, the liability is to keep the plan whole and healthy and fund those benefits. In the case of a DC plan, the employer's liability or obligation is simply the promised contribution. And in terms of who's bearing the risk and ultimately who receives the benefit of stronger returns, in the case of a DB plan, the employer is bearing the risk and should be able to use any surplus on the investment portfolio, any excess returns above expectation, to reduce their contribution commitment. In the case of a DC plan, the employee is the investor, the saver. They bear the risk, and ultimately at retirement, if there aren't sufficient funds available, they would have to either kick in more money or retire later. The risk of withdrawal, to the extent that there's any risk of withdrawal and the impact of people leaving the plan causing gains and losses, that is only present in the defined benefit plan. And ultimately, the decision maker in these two vehicles is quite different with respect to setting investment policy. In a defined benefit plan, since the employer bears the risk and the rewards, they set the policy and the strategy. In a DC plan, since it's the employee making the investment decisions, taking on the investment risk, they set their own strategy, make their own choice of investments, usually from a field of investments that are open to them. So defined benefit pension plans, the more complicated vehicle of the two with respect to investment strategy and possibly the more likely one on the exam, although no guarantees. Let's cover some of the basics here. Risk and return. From a return perspective, the return needs to be sufficient to cover the obligations. Okay, when setting up the funding of the plan, the actuary has made some assumptions regarding the required rate of return or the expected rate of return to meet those obligations, and that's going to set the tone for the expected return going forward. To the extent that a higher return can be achieved, this will lead to lower contribution requirements, because again, the employer, having borne the risk and received higher returns, will use that surplus to subsidize his contribution requirements. So that's how higher returns play through in the system. Risk is often a function of, or risk tolerance is often a function of whether or not there is surplus in the plan. In other words, is there a cushion? Is there some sort of cream on the top, as it were, to enable the risk taker to take more risk? What's important here is the financial status of the employer. So the employer really needs to consider pension risk in the context of overall corporate risk. For example, looking at the balance sheet and looking at other other items of leverage. Is the balance sheet levered in other ways? Looking at debt ratios, considering the profitability of the business. To the extent that there's less leverage and the debt ratios are perhaps modest and the business is profitable, the employer is in a strong financial position and can always sort of backstop the pension plan if necessary. That would indicate a higher level of risk tolerance. So you as a candidate are going to have to look at the situation, read into, if this section comes up, read into those type of particular factors that are at play in that situation. Make a determination as to whether or not you think this is a situation with above average risk tolerance or below average risk tolerance, based on some of those factors. In terms of the commonality issues, what you need to be aware of is that there might be a correlation of returns between the return in the pension plan and the firm's performance. And it would be useful, or could be useful, to set up the investment strategy in such a way that the pension plan is doing well, or quite well, when the firm is doing poorly. What you don't want to have happen, what you want to avoid, is the pension plan's returns are depressed and the company's profitability is depressed. Okay, that's like a lose-lose situation. Employers got to kick in money right at a time when they can't afford to do so. So what some pension plans do, what some of my clients have done personally, is they might be businesses in a more cyclical industry, so they're more vulnerable to economic cycles. Perhaps they're a company that's exposed to commodity prices, they're in the forestry sector, the mining sector, and their earnings are more volatile. They might choose to hire managers whose returns are more stable. They may indeed choose to hire investment managers who don't invest in cyclical sectors, so they're not participating in the similar at similar times to economic success as the company. That would be an example of setting it up in a way that's imperfectly correlated. In terms of particular features of the pension plan, if the pension plan offers commuted values or lump sum values, the time horizon then decreases, and that would indicate a lower level of risk tolerance or a lower appetite to take on risk. And some of the other factors that need to be considered for a defined benefit plan is the nature of the workforce. How old is that workforce? Is it closer to retirement? Is it further from retirement? And on that note, what proportion of the members are already retired? Clearly, for a pension plan that's very young, immature, long period to retirement, that indicates a much longer time horizon, perhaps an increased risk tolerance, and vice versa for a mature pension plan. In terms of stepping through the constraints, from a liquidity perspective, number of people retired. Obviously, a group of retired members is drawing pensions immediately, and a higher level of matching of assets to those obligations is required, a higher level of income through fixed income coupons. Consider the size of the contribution that's coming in and the extent to which there's positive cash flow. If contributions are covering cash flows, there wouldn't be any imminent liquidity situation. But that obviously changes as pension plans mature. I mean, there may not be liquidity concerns right now, but liquidity concerns can develop. So I think you want to mention that as well. And any commuted value or lump sum payments that are being paid out to members, they may be sort of spike-ish. They may spike up and down, indicating some concerns around liquidity, or there may be a fairly small percentage of the cash flow. So that needs to be considered. To the extent that commuted values or surrender values or lump sums are paid out regularly, that has some impact on the ongoing level of liquidity and the need for liquid assets. Moving on to the next few constraints, the time horizon. It's important to know whether or not the pension plan is a going concern, or whether it's in drawdown and wind-up phase, or imminent wind-up, or shutting down of the plan. Obviously, if it's a going concern, you're going to be interested again in the proportion of members retired and the average age of the members, as we were discussing earlier. You may, in fact, split the pension plan up into a couple of components. You may think of it conceptually as we're going to deal with a retired group in a certain way and match off those obligations with more conservative fixed income instruments, and we're going to deal with the active group differently. Or if there are two sub-pension plans, if a company has two pension plans and they're quite different, you may argue that it's not appropriate to have a master trust with one investment strategy. You may argue, and logically probably should argue, that because those two animals are so different, they require different investment strategies.